Good morning and welcome to NDTV Profit. The big story we are tracking today, the stage appears to be set for the Fed to cut rates. Jerome Powell, the Fed chairman, has given a hint at the Jackson Hole speech. To take this conversation forward, we are being joined by Mark Matthews. He is from Julius Baer. We don't need any special introduction. He's a big global market expert. Mark, welcome to the show.
Thank you, Mowgli. Thanks for having me on.
Yeah, so the first question, let me quote from what he's saying. Fed Chair Jerome Powell said, "The time has come for policy to adjust." Is September 18 the time that he is referring to?
Yes, it is. The first rate hikes were way back in March of 22, and as you know, they raised rates by the fastest pretty much ever, from 0 to 5%, and they've been at 5% for quite a long time now. So using the labor market as an excuse, because the unemployment rate has been rising over the last few months, the Federal Reserve is now indicating that it will be cutting interest rates. And what's most interesting in the speech that Jerome Powell gave at Jackson Hole on Friday is that he did not use any of the language that his colleagues had been using, like methodical or gradual, to describe these impending rate cuts. In other words, he's inferring that they could be quite rapid.
Okay, so of course he mentioned about, I think it's a kind of a caveat being the central bank chief. He's saying timing and pace will depend on incoming data. Now, is incoming data good enough to go at an aggressive pace, or will it be measured?
I can't answer that question. We'll just have to see. But what I would say is that if you look closely at the unemployment numbers and why they have been rising, a lot of it is coming from new entrants joining the workforce who have not yet found jobs, so they are still classified as unemployed. But the fact that they want to come back in the labor market is a good sign. It shows they think there are jobs out there. So, for example, Challenger, which is an outplacement company, they run an index that tracks job cuts, people getting fired. And their most recent job cuts index for July showed only 26,000 people were fired, compared to an average over the last 20 years of 63,000 per month. So I think that actually the labor market, it's debatable, quite debatable, that the labor market is cooling, is getting softer. In fact, the rise in unemployment to me looks more driven by confidence in the economy and people coming back into the labor market.
Right. So do you think that the markets have already priced in a 25 basis point rate cut?
Oh, yes, very much so. If you look at any one of the markets that track the Fed funds rate, they're all implying very aggressive rate cuts going forward, which I must say as a house we disagree with. We do think that rates will come down. We are looking for the first cut in September, but we're not looking for 8 or 10 or something like that, which is what many of these markets are pricing in.
So which means that we can see at least 150 basis points cut over the next 6 to 9 months?
I think we're looking for around that range, yes. We're looking for a terminal rate of 3.25 for the Fed funds rate by the summer of 2026.
Okay, so if that is the case, how will funds shift now? Will they shift from geographies and different markets, or will they also shift among different asset classes?
There will be some shifting. I imagine that one of the more important ones is that a tremendous amount of money went into so-called money market funds, which invest in very short-dated treasuries and other very safe short-dated financial instruments. As rates were rising and as rates were high, that money that is in the money market funds will probably want to move into some of the longer dated fixed income, and that could be treasuries. It could also be investment grade corporate bonds, because the shorter dated ones will be repricing at lower yields going forward. And we've obviously seen weakness in the US dollar, which I think is reflecting the impending rate cut cycle. And typically, a weaker dollar is good for markets outside the United States. And I was interested that the MSCI World Index made a new high on Friday. The S&P is a little bit below its previous high, but world markets are starting to rise as well, because obviously when the dollar goes down, it means the other currencies are going up, and that tends to attract fund flows. So there are lots of things that can happen. Gold is making new highs, as I'm sure you know. It's above $2,500 an ounce now. That would also be reflective of this impending decline in interest rates.
So from what I understand, from what you have been articulating, it will not be advantage equities, I guess. Only in the short term we'll see equities moving up. So because the markets have, equity markets have already run up a lot.
Well, actually, we prefer equities ourselves because we think that the economy is still strong. And I must say there's a slight contradiction here between an impending rate cut cycle and a view that the economy is strong. But because most people would think, well, if you're cutting interest rates, that means that, you know, the economy is going to get a lot weaker. I would point out that there have been in history different times when the Federal Reserve has cut interest rates to normalize rates, just to bring them down to a more appropriate level. And there weren't recessions, and that's what we think is going to happen this time. So if that's the case, then earnings growth will remain strong. It is strong, by the way. Earnings growth in the second quarter was over 10%. We think it will be over 10% this year. That's for the S&P 500, and again next year. So as much as fixed income should benefit and probably will benefit from falling interest rates, it doesn't mean that equities won't continue to rise.
Right. So you mentioned about dollar going down and therefore other currencies going up. If that's the case, do you think the yen carry trade will play out again?
I think it will. I think the difference between the two central banks' policy rates is ultimately what decides the dollar-yen rate. And even if the Federal Reserve cuts interest rates, we're looking for 4 rate cuts by March of next year, and by March of next year for the Bank of Japan to raise one more time, there'll still be a 400 basis point differential between the Federal Reserve's policy rate and the Bank of Japan's. And so that does make it interesting to borrow in yen and invest elsewhere.
Okay, so let me come back and sharpen my focus on India. In all this kind of dynamic shift that we are going to see over the next 6 to 9 months, do you think it will be advantage India, or will funds move out of India as foreign investors try to realign to the new rate regime?
I think much will depend on the trajectory of the U.S. stock market, because it's been, as you well know, such a very good market over the last 15 years that it's really crowded out almost every other market from the attention of global fund managers. I mean, why bother investing somewhere on the other side of the world that you know very little about if things are doing so very, very well at home in the companies that you do understand, like these big technology companies. So if the outlook for the big technology companies remains robust, and for the US in general, and I would note that within the S&P 500 index, there are important sectors like the financials, like the real estate sector, which also broke to new highs last week. And that does not corroborate the idea that the US economy is going to slow down anytime soon. So I guess what I'm trying to say is that things still look very good in the United States. And as long as they do, other countries will probably not garner that much interest from global fund managers.
You don't seem to be too positive about the India growth story, because India is the fastest and perhaps the only growing, strong growth economies of the world if we leave US out.
Well, your question, I think, was what would investors do if, and I answered by saying that I think the U.S. is still looking very good, so I don't think investors are going to become more interested in other countries. But right. We as a house have liked India for quite a while now. I personally think that it will be one of the rare markets in the world that will outperform the U.S. over the next 5 years. But I sit here in Singapore, I'm a little closer to it than people in Europe or the United States, and I spend more time looking at it because that's my job, so I can see the bright future. They don't spend as much time looking at it, and so I guess they haven't really invested that much in it for that reason.
So do you think India is not overvalued? Because there is a general impression that India is overvalued.
It is overvalued. It should come down a little bit from here. The earnings growth has decelerated from the mid-teens last year to around 6-7% in the most recent quarterly results, and on 25 times forward earnings, it's definitely more expensive than the average long-term forward price earnings multiple, which is 20 times. Yes, I think it is a bit overvalued, and I would like it to come down, but I don't know if it will, because the domestic flows are still very strong.
Okay, so what will turn the story for India? Do you think RBI will follow Fed and cut the rates here as well, and will that make India a little more attractive?
I imagine the RBI will follow the Fed and many other central banks as well, by the way. But to come back to my earlier point, the relative attraction of India is, there are two sides of the coin. One is that India is doing very well. I don't see that changing. But the other side is that the U.S. is doing very well, and you need to see the U.S. do less well. I don't mean go into a bear market, but I just mean stop being the really incredible bull market that it has been for the last 10 plus years, for interest to broaden out to countries like India. And I think what I'm trying to say is I don't really see the case for the U.S. Bull market ending anytime soon. And as long as that is the case, that the bull market in the U.S. is intact, then you are not probably going to see a lot of investors trying to go out to other parts of the world to seek better returns. I mean, why should they?
Right. Unless the election outcome or election results could play spoil sport. What's your view on how politics will play after the election results in the US?
Well, that's a good point, because a lot of things could happen. And one thing that could happen is that Kamala Harris could be president, but the Republicans could gain the Senate and keep the House of Representatives. And if the Republicans control both chambers of Congress, I think they will not be supportive of any spending bills from a Democrat White House, and that would slow the growth trajectory in the United States. And that might make the rest of the world more interesting from an equity perspective. But I would say that is not our base case scenario right now, although Mrs. Harris is in the lead, Vice President Harris, in the opinion polls. In fact, you must remember that in 2016, Hillary Clinton was vastly in the lead in the opinion polls at this time, and she lost to Donald Trump, and Biden was well ahead in the opinion polls in 2020. He just barely beat Trump by quite a small margin. So I would say a lot can happen. There are scenarios like the one I described with U.S. politics that would cause a deceleration in growth in the United States and make the rest of the world more appealing. So we'll have to wait and see which one plays out.
Great. We'll have to clearly wait and watch till the September 18th, where the rate cut is a kind of a given, and the election results. But the India story is still intact. Mark, thank you so much for joining us and taking our viewers through your thoughts and expert views.